Real estate are basically land and anything that is attached to it. That is what we call the real estate property or properties. Land and anything that is attached to it. So you can be able to value a house. And when you're valuing a house, you need to include the price of the house and that of the land. You cannot say that this house costs this, but then you forget the price of the land. So that is what it means. I want you to say that real estate is a term used to mean land. Real estate is a term used to mean land and anything attached to it permanently. Real estate is a term used to mean land and anything attached to it permanently. Real estate is a term used to mean land and anything attached to it permanently. Let's look at valuation of properties. Valuation of properties. So real estate property can be valued, and there are so many ways of valuing real estate property. The first one is called discounted cash flow method. The second one, the first one is discounted cash flow method. The second one is gross income multiplier method. Gross income multiplier method. Gross income multiplier method. Gross income multiplier method, which is also called GIM. The next one is called direct capitalization rate method. Direct capitalization rate method. And then we have, so they are basically those three. So we can start with the first one, which is discounted cash flow method. Discounted cash flow method. Discounted cash flow method. Discounted cash flow method. So let's look at an example of how to value property using discounted cash flow method. So we start with discounted. Discounted cash flow method. So in this particular method, we're going to look at the same way we normally do our discount, the way we normally discount our cash flows. We have period there. So the period are in years. And then we have cash flow. We have cash flow. Then discounting factor. So assuming that the examiner has given you something like this, and you are told that we have here 6, here we have 8, here you have 10, and they are in millions. Then additional information, additional information, we say that risk-free rate is 8%. 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 Market premium is 2%. And the beta factor of the firm is 1.5. So additional information. Risk rate is 8%. Risk rate is 8%. Market premium is 2%. Market premium is 2%. Beta factor of the firm is 1.5. Beta factor is 1.5. So using we are looking at real estate property, and these are the method. The method is called discounted cash flow method. That is the first method. And we are looking at an illustration where we are having the time in years. We have between 1 to 5 years. So this one, what we are saying is that you assume that you want to value a property, real estate property, which we say that real estate property is land and anything that is attached to it permanently. So if you want to value them, then you can be able now to look at this. What we're doing is that you're trying to assume that you're going to get rent. These are cash flow, which are rental incomes. So in the first year up to the 5th year, you'll be getting 6 million every year. Then from 6th year to 10th year, you're getting 8 million every year. From the 11th year to 14th year, you're getting 10 million every year. So then the question is, what will be your value? What will be the value of this particular property? You can use cash flow to value. So if you want to buy a property like a house, you can be able to use this formula to know how much can I pay for this house. Let me make it more practical. Violet, Evans, welcome. So Violet, what you're saying is that assuming that you want to buy a building, you need to be able to look at the rooms. Then you estimate what is the price for this room and the market price in that area. So you can be able to see that this house has got maybe 24 rooms, and each house gives you 10,000. Each room gives you 10,000, right? So that is 24 times 10,000, that is around 240,000 per month. So 240,000 per month, you can be able to calculate in terms of years. You can say that that is times 12 of 240. That will be 2.8 million. Then you say that in year 1 up to year 5, you can be getting 2.5 million before you increase your rent. You increase the rental income. In year 6, you can now increase it because landlords normally increase. Then you are saying that you assume that now this property can be able to give you this income maybe for the next 30 years or 15 years or 20 years. You can be able to estimate. Then from there, you can be able to calculate and say, okay, so how much can I actually pay on this? How much can I actually pay on this? So that is what we are saying. You can be able to know how much you can use to buy the property. How much you can be able to buy the property using that formula. Now, the additional information that you've been given after the cash flow is that the risk-free rate of return is 8%. We also have market premium as 2%. The beta factor is 1.5. Required, right? For me, required. Required. Determine the firm's cost of capital. Determine the firm's cost of capital. That is the first thing. Determine the firm's cost of capital. That is the first one. The second question. Value of the above apartment. Determine the value of the above apartment. Determine the value of this apartment. Determine the value of the apartment. Determine the value of the apartment. So the first one, the cost of capital, and then the second one, the value of the apartment. So you have to get the cost of capital first, so that you can now use it. When you get the cost of capital, you can use it to discount the cash flow and get the value of the apartment. So that's why the first question is asking you to give the value, the cost of capital. Now, how do you calculate the cost of capital? With the information that you've been given here, whenever you see beta, think about CAPM, right? So that should be your gospel. Whenever you see beta, you think about CAPM. Anytime. So you see beta, think about CAPM. And CAPM is a formula that can help you to get the cost of capital. So even without the examiner asking you to calculate the cost of capital, you should know that you want to discount. And for you to discount, you need a discounting rate, right? And that discounting rate you cannot get unless you have the cost of capital. And that cost of capital you can get it through CAPM because you're not given it there. So where you see beta, you think CAPM. So let's look at CAPM. So we are saying that CAPM, the cost of capital or cost of equity is equal to RF plus ERM minus RF into beta, right? So we are having our RF, which is 8%, plus into market premium has been given. So that is this one, the figure that should be here. That is what has been given. So we just take our 8, not 8, but market premium times 1.5. Meaning that market premium ordinarily, it should be the difference between the expected rate of the market, expected rate in the market minus RF. That is what we call market premium. So it has been calculated. So therefore, you're going to have 8 plus 3, which will give you 11. Now you have a rate that you can now use to discount this. Of course, it helps you to get the rate. This calculation will help you to get the rate that you will now use to discount, but at the same time, you are answering the question that you are told to calculate or answer. Now, after this, we will now come and now look at discounting. Now, we are having time, and then we have 1 to 5. Those are in years, right? They're in years. 1 to 5, we have 6 to 10, we have 11 to 14. So those intervals, those are where you can be able now to increase the cash flow. So that means that your first cash flow, which is this one, in millions, or let me just say they're in thousands. So here we have 6,000, we have 8,000, you have 10,000. What we are saying is now you need to discount. And as you can see, listen carefully. Between year 1 to year 5, we have a regular cash flow, meaning that the cash flow is the same. Between year 6 to year 8, we have another regular cash flow. Every year it is the same. So that is what they mean when they say between this to this. Now, we can now come here and get our discounting factors for this particular period. So, get your discounting factor. So what are we using? Are we using PVIF or PVIFA? PVIF or PVIFA?
PVIFA if the cash flow is the same for each year.
Thank you. So using PVIFA. And that is 11%. Now we have the rate, so using 11%. Now, for the first year, remember PVIFA, when you use PVIFA, it gives you from the first year until the last period. So if this is for this line, it will give you up to 5 years. If you do it for this line, it will give you from the first year up to the 10th year. If you do it here, it will give you from the first year up to the 14th year. So PVFA, you cannot do for only the specific period in the middle. You'll be able now to do it from the beginning to the end, and then you get the difference. You'll be able to see what I'm going to do. So let's start with the first one. So PVFA for the first one, we are going to have here PVFA for 5 years at 11%. What will that be? We know the formula for PVFA, right? 1 minus into bracket 1 plus r negative m, all this over r. Our r is 11%, so you say it is 11%, so 1.11 raised to negative. The period is 5, maximum there for the first one. So you say negative. So
I'm getting 3.6.
1.1 raised to negative n, which is 5. Then 1 minus the answer, then divide by 0.11. So that is
3.6959.
3.6959. So that is the first one. Now, the second one, you get for the whole period up to 10 years. So it will give you from 1 year up to 10 years, then you minus what you already have. So you're going to have PVFA for 10 years, 11% minus PVFA for 5 years, 11%. So that is what you're going to calculate. How will that appear? So that will be, do it for 10 years now. You take 1.1, 1 raised to negative 10, then 1 minus the answer, then divide by 0.11. So we're getting 5.8. So you take 5.8, 8892 minus 3.6959. 3.6959. 3.5969. Then you come for this one. Take PVFA for the whole period up to 14 years. So that is 14 years, 11%. Minus PVFA for 10 years, because at least you have calculated up to 10 years. So take the one for 10 years. So 10 years was, so PVFA for 10 years, 11%. 10 years, 11%. And that will be, let me see 14 years. 14 years, what are you getting? So it is 1.11 raised to negative 14. Then 1. Divided by. So we have 6.98. 6.9819 minus now 5.8892. So what are you getting? So those are the figures that you're going to use to discount. That is how you can be able to calculate that one. Then use that figure to discount. Now, when you're now discounting, Or we are now saying that the present value, so present value we can now have the first one. You can say that the cash flow was 6,000 times 3.6959. What do you get? Then we have 8,000 times 2.1933. Then we have 10,000 times 1.0927. So then what are you going to get?
The first one, 22,175.4. The second one is 17,546.4. And the last one is 10,927.
And then
total is 50,648.8.
50,648.8. Right? So that is what you get. 50,648.8. So that is the value. That is not present. That is not net present value, but is the present value. So we can get the value of that property using discounted cash flow method. So that is the present value. Is it easy? Let's now do another example. Let's try another example. Say illustration 2. Illustration 2. The following is a 10-year forecast. The following is a 10-year forecast. The following is a 10-year forecast. The following is a 10-year forecast of ABC apartment. 10-year forecast of ABC apartment. The following is a 10-year forecast of ABC apartment. The following is a 10-year forecast of ABC apartment, full stop. The NOI, the net operating income, will stabilize at a growth rate of 2%. The following is a 10-year forecast of ABC apartments, full stop. The net operating income, that is NOI, will stabilize at a growth rate of 2%. It will stabilize at a growth rate of 2% in year 9, 2% in year 9, and thereafter. The NOI will stabilize at a growth rate of 2% in year 9 and thereafter. Yesterday, we agreed that NOI is the same as the earnings after tax, right? If you're not provided with taxes, NOI is the same as net operating income is the earnings after tax. And so it is basically the cash flow. That is the cash flow. So this person is telling you that the cash flow will stabilize at a rate of 2% in year 9 and thereafter. So it will stabilize at a growth rate of 2% in year 9 and the year after. And thereafter. Full stop. The required rate of return is 12%. The required rate of return is 12%. The required rate of return is 12%. Full stop. The required rate of return is 12%. Full stop. The required rate of return is 12%. Full stop. Compute the present value of ABC apartment. The required rate is 12%. Full stop. Compute the present value of ABC apartment. So we have year, we have year, we have cash flow. And then we have, yes, so we are given one for year 1, year 2, year 3, year 4, 5, 6, 7, 8. And then year 9 onwards. So we have 338. 355, 740. 375, 373, 527. 388, 468. 44007. 404,007. 416. 120. 428. 611. 441. 469. And then the last one we are told now, year 9, it will stabilize. So year 9 we have not been given. They are saying the following is a 10-year forecast of ABC apartments. The net operating income will stabilize at a growth rate of 2% in year 9. So these are the incomes for each year. Then after year 8, we are supposed to go to year 9. So they are saying now the income in year 9 will now start growing. From this one, year 9 will be 2% of this, and it will keep on growing now, going forward into infinity and thereafter. So what we're basically saying here, Evans, is that you are able to estimate the revenue that you can get or income that you can get from your apartments for the first year up to year 8. But then after year 9, you are trying to say that now the cash flow will keep on now growing. From year 9, it will now keep on growing now at a rate of 2% for the rest of the life. So you might not know perpetuity is how long. It can be for 100 years, 50 years, you don't know. So that is why they are saying it is forever, forever, because it is perpetuity. Now, we are now saying that from year 9, we don't know the cash flow. What we know is that year 9 going forward will be perpetual growth or constant growth at a rate of 2%. That is infinite cash flow. So from year 9, which is now infinite, how much is that we don't know? So you can't now calculate 2% of this to be year 9, 2% of that to be year 10, 2% of that. The question is, where are you going? Because you don't know. If they talk about thereafter, that is infinity, then you don't know how many years they are. Now, what we can now do to get the year 9 onwards, use Gordon's formula to be able to calculate the infinite cash flow. Infinite cash flow. Infinite cash flow. So what is that? Use the formula that we learned. So P is equal to D into 1 plus G over KE minus G. Was it KE minus G? Right? All over KE minus G. And remember the formula for Gordon's the formula for Gordon's growth rate. So this is the formula where we are having a growth. G is the growth. So what if we were making K to be the subject of the formula? K would be KE is equal to G naught into 1 plus G lower P, and then we have plus G. Right? So that is if you are using the Gordon's formula to calculate the cost of capital. But if you are using it to calculate the price of the value, this P refers to the value. Because this P is basically the price, right? It is a price of a share price. What if you are now getting the total number? It will be the value of the shares, because it is now the price times the number of shares that will give you the value. So this formula still works for the value. The only difference is that per unit is how much. The only difference is the number of shares. So if you know the value per unit times the number of shares, you're okay. So this formula can be used to get the value of the cash flow in perpetuity. So we can be able now to replace this. They said that the required rate is 12%, right? So we can come here and now say that P, which is the value, is DO or D naught is the last declared dividend. When you are looking at the dividend, we say that the last declared dividend that we know is DO. Here, the last declared revenue is the one that is now referred to as D naught. We have so many of them, but the last one that was declared, the one that we knew, the last one, is in year 8. So you take your 441, 469 into 1 plus growth rate is 0.02, 2%, right? All over 0.12 minus 0.02. When you calculate this, you should be able to get the value that should be here. Can you try for me and tell me how much it is? So what are we getting? Well, yeah. Let's take this one is
4 million.
Give me
4 million 502,000
4 million
502 983.8.
So that is the cash flow in perpetuity from year 9 when it keeps on changing. So you get a total here. So now that is the first thing that you do. You need to get the cash flow in perpetuity, and you simply use this formula. After doing that, now you can now do what? Discount. You can now discount. Because you're told to use or to get the present value. So get the discounting factor. So we are given 12%. We are given 12%. Discounting factor for 12%. What are we using here? Is it PVIFA or PVIF? We're using PVIF, right?
PVIF, yes.
Because the cash flows are not the same. They are irregular. They are irregular cash flow. And formula for PVIF is just, right? Is it over R? Is that the formula? Or it is just like that?
Just like that without over. Yeah.
Not over. Okay. So can somebody now calculate for us? For year 1, year 2, year 3, year 4, what will be the value? Now you write all of them. Then in year 8, this is the last year that you know. Year 9, you don't have a figure. So what you do, use the discounting factor for the last year or year 8. If there were 7 years, then number 8 it was infinity. Use the one for year 7. The last discounting factor is what you use on the infinity period. So we use 0, this one. Then now you multiply them to get your answers for present value. So to gawane, somebody Evans try this, check this and this. Violet, check this and this. And then Faith, check this and this. I can now book this one. Faith, check that one. I try the remaining two. To gawane, we can share.
The first figures, the first and second figure, I am not seeing it well. Is it 355, 740?
This one.
Yeah, what is it? Three what?
388. This one is 355, 740. That's true.
Okay. Then that's fine.
Give me the figures.
Year 3, 265,876.52.
Yeah, it is 265.
265,876.52. Year 4, 246,871.41. 0.41.
Year 1. 302. 514.56. 52, sorry. 52. 283.
Yeah, which one?
Year 2.
Year 2 is
283. 567.
5.
67.47.
567. Did you multiply? This one is 0.7972. 0.7972. Did you put 70? The last one. So we have 355,740 times 0.7972.
And 0, 7, 9, 1, 2. Yes.
I'm getting 283,595.928. And I can see 4 times 2 is 8. So 8 must be there in front. But you decided to ignore us, eh?
Poleni, my network has issues.
The way you are clear. Okay,
I've
so
logged it again.
yes, don't worry, don't worry. We can now add them. If you add them, you'll be able to get your total. So let's add them and see who is going to be accurate. What are you getting?
I'm getting 3,729,827.64.
So 9 is not correct. Okay. 3 million?
729,
Mhm.
827.64.